All right. Next, we're going to look at the income approach. So we start with something called gross domestic income. Okay. And again, this is all of the incomes added together. So the different incomes are wages, interest, rent, and profits. And again, these are the incomes paid to the four different factors of production: labor, capital, land, and entrepreneurial activity. Okay, so here's some examples. Wages, right? So salaries, labor, income. So this is the one most of us are familiar with. Rent. So this is rental payments for things like farms, land, houses, stores, buildings, all those sorts of things. Then there's interest, which is basically income payments to people that loan money. So this could be like a savings account. So whether you knew it or not, when you save money in a bank, the bank loans your money to businesses, and if they pay you an interest rate on your savings, then you're basically getting rewarded for providing those loanable funds. And then profits, of course, is the last one: payments to entrepreneurs, proprietors, partnerships, and corporations for taking on risk. All right, so once we know what gross domestic income is, we need to add indirect business taxes and depreciation to get to GDP. These last items are called non-income expense items. Okay, so I'm going to go over to my, unless I've got it on the next slide. I don't. All right, so what I just said is that GDP, using the income approach, switch over to my doc cam so you can see this. GDP, using the income approach, is equal to gross domestic income, right? Which again is all those four different incomes to the factors of production. And then we add to that indirect business taxes, and then we add also depreciation. Okay, so that's how you get GDP using the income approach. Again, these last two items here are called non-income expense items. All right, so let's think about why we have to add these things into GDI, gross domestic income. So first of all, what are indirect business taxes? These are all business taxes except the tax on corporate profits, right? So taxes on corporate profits, profit is one of the incomes, and taxes on that are not included in this. So this does include sales taxes, business property taxes, right? Every business tax except for the tax on corporate profits. Okay, so we need to add that back in to income. Now this gets back to when I said we are ignoring things like taxes, right? When we think about the circular flow of expenditures and incomes, right? So it's not exactly the case that when you buy a $5 energy drink from a gas station that they get $5, right? They have to pay some sales tax, right? And so that's why we're adding it back in, because when you spend $5 on an energy drink, let's say that the gas station has to pay 50 cents in sales tax, right? So what the income they're getting is $4.50. And so for us to get back to the expenditure approach, which was the $5 that you spent, we have to add that sales tax back to the gas station's income of $4.50, right? So that's why we're adding these indirect business taxes back on, so that we can get back to the expenditure approach, right?